Welcome in, everyone, to the Bend, Oregon Real Estate Podcast. I am your host, Rob Eggers, principal broker here at Duke Warner Realty. Over 20 years real estate experience here in Bend. And I am joined today by a friend of mine, Brandon Roberts, who is a great mortgage broker here in Bend. And Brandon and I have been working together for quite a long time. You've been doing this, what now, about 15 years?
Yeah, on the mortgage side, it was financial management for over 20 years, but specializing in mortgage financing, and now as a mortgage advisor, I guess, as you'd say, for about 15. Yeah.
Okay. And you came up from Klamath Falls.
Yeah.
And what year was that?
That was 2015.
Okay.
Yep.
Yeah.
When I showed up at your office and asked for some business, and
so been in Bend about 8 years.
Yeah.
But in the mortgage business about 15 or so.
Correct. Yeah.
Well, Brandon's someone that I always love to I love to pick your brain, just get your opinions on things. You do a lot of classes. In fact, you teach a class about rates, and we're going to do that class here coming up at Duke Warner Realty, which I'm excited about. But one of the reasons I wanted to have you on is, the interest rates today are pretty much top of people's mind when it comes to real estate. And we have gone through this huge fluctuation in the last 12 months. Maybe we could touch on that a little bit, because literally a year ago, well, not so much now, but say the last spring, you could get a mortgage for in the threes last spring. And then we went from 3 to 6, and then, by June or midsummer, and then by the end of the fall, we crept into the 7s. What do you think about that rate and that rate hike in 12 months?
And at least in the modern financing world, I think nothing like that since the 70s that we saw. It was hard. I remember last year, Rob, my wife and I went to Portugal, and while the rates really started to move, we were there in February, March, and every day fielding all these calls with an 8-hour time difference. What's going on with rates, Brandon? Why is this happening? Clients trying to get them locked in and so forth. But it was, 7 times the Federal Reserve, their board of governors, 12 of them, FHOMC committee, they get together and decide. But they really knew that inflation, which is the driver of rates, had to be controlled.
Yeah.
It was, and we felt it. We all saw, what things were costing constantly. I heard one real estate agent once say that, rates have been on sale for a long time, and they have, and now they're back to kind of, I guess some normalcy, but it's hard to stomach. Yeah. So it was a big change, and we just didn't know where the ceiling was going to be.
Yeah. Yeah, we had in our office, we picked the brains of several different lenders. We got variations from 10% to 5% when we were asking, hey, where are rates going to go? They kind of topped out there at the low 7s, and I don't know if we're going to go back there or not. We'll get to our predictions at the end here for rates, but I think it was just a huge, mental adjustment that people had to make. And I think that's what really slowed the market down in a lot of sense, because they started looking at the rate difference being like, I shouldn't buy a home right now.
And interestingly, Rob, that's part of the mental process of the Fed. That's why we hang on every word that comes out on these press conferences too, from Jerome Powell and others. It's how did they say it? What did they say? Because it affects our psyche and what we're going to do. If we think rates are coming down, maybe we'll make a move. So yeah, the psychology of how things forecasted and how they're presented has a huge bearing on our actions, what we do.
For sure. I mean, all you have to do is look at the headlines, and if the headlines are negative, people get scared.
Yeah.
And it makes people pause.
Yep.
For sure. And I think with part of that, that adjustment that people had to make, they kind of almost mentally decided we just shouldn't buy a house right now. Rates are too high. We shouldn't buy a house. And in having this conversation with you earlier, you have an interesting perspective on that because you actually argue against that. Because there's a lot of other factors other than rate. So maybe you can get into that a little bit. Why you don't think it's necessarily a terrible time or a bad time to buy?
Yeah, I think it's a great time to buy, because I think you have to remember when rates are low, home prices are high.
Yeah.
Typically,
yeah.
Right? Because you have a broader market, you have more people buying.
More competition.
So fundamentally, that's nothing new. Everybody kind of knows that. We feel good about the interest rates. Boy, get in to buy. And then you see bidding wars and you see all the things that you and I saw over the last couple of years when we just saw home prices going up so fast. So the question is, well, is it better than just to finance more because rates are lower and lending and credit is more available? There's a balance, like with everything. But when you try to seize opportunities and you say, okay, any kind of market-driven activity or purchase is kind of timing. It's when is the best timing? The best timing would be when home prices are the lowest and rates are the lowest.
Absolutely.
How many hit that, right?
Good luck hitting that one.
Right.
It's a lottery ticket right there.
It's a lottery ticket. And we saw that in the recession of 08, 09, where home prices 10, 11, 12 were low, rates were low, but guess what? Nobody had jobs.
Yeah,
so
exactly.
That was the other part of it. And that's what the Federal Reserve, they have a dual mandate from Congress to control two things, employment and interest rates. And so, or at least try to temper those two things. And so when we see the moves to get all three to line up, employment, everyone's got great jobs and wages, home prices are low and interest rates are low, is never going to happen.
Yeah.
If you can get 2 out of 3, great.
Yeah.
If you get 1 out of 3, that's probably likely. And some miss the boat altogether. And I think when we talk about rates, even though they are higher, we have to remember mortgage rates follow inflation. Always have, always will. That's why we saw inflation went up sky high. Guess what happened to mortgage rates? They went up.
Yeah.
And I think there's an argument right now, and I think a lot of insiders would say that we've crested on the inflation front.
I think so.
I think
I look at what it takes to go get a bagel and a cup of coffee, and I'm still shocked by it. So I don't know. When you say crested, does that mean we're going to start coming down now?
Yeah. Interestingly, one of the measures the Fed uses to measure inflation is the CPI, Consumer Price Index. PCE is another one they use, but they measure wholesale inflation, retail inflation. You mentioned the bagel and the cup of coffee. Interestingly, with the CPI, they strip out food and energy. Interestingly, because we always go, well, why would you take out those numbers? Because that's what I feel.
Yeah.
That's kind of what I see, like at gas prices, my power bill, all those things. Well, those aren't factored into the inflation numbers, which seems counterintuitive. But the reason they do it is because the Fed can't control those through monetary policy. So they don't utilize them. So sometimes we see inflationary numbers coming down, but it's not reflective of food prices and so forth. Generally, they follow suit. But when it comes to mortgages, shelter costs, they factor in all kinds of different things, utilization of credit. But when I look at, has it crested? Yeah, the challenge is that the data that they use to make that determination is always reviewed and analyzed in the previous or preceding 12 months.
Oh, right. So it's a little behind the curve.
Yeah, it's kind of like trying to drive the car looking in the rearview mirror. You can do it
instead of looking out in front of you.
Yeah. So that's part of the, I guess you could say, the criticism of the Fed. And that's why sometimes they can overcook something, or maybe they say, well, they should have made this adjustment that way. Well, they're trying to drive the ship looking backwards.
Yeah.
So they're trying to collect data. They're looking at the last 12 months, but things change rapidly. And so hopefully now, when they really look at the indicators, and I think there's a really strong argument that inflationary numbers, in fact, they have been coming down. And we've seen it reflected. What did we just say? What were interest rates back in December, January?
Yeah, they were up there 7.
Right. And now they're 6.25 or so. So they've already come down at a point, and we've seen inflationary numbers have come down. Now, they haven't come down as fast as the Fed has driven rates up.
Yeah.
And that's what they're concerned about. Why isn't it? Well, employment has a part of that because employment is still strong. Unemployment is low. So it's a complicated thing. I mean, it's not, I'm a mortgage advisor. If I had that, some of the brightest minds in the world and economists can't.
They still can't get it right.
No.
I know.
No.
It's everyone's making educated guesses.
That's it.
Yeah. So for thinking about buyers who are out there, trying to get into a home, they're bummed out because the interest rates are high, and they think about, well, this is not affordable for me on a monthly payment side. So maybe we could look at that. Just look at some of the differences between like rates, say a 3 compared to a 6, or even a 6 compared to a 6.5, or a 6.5 to a 7. What are those real world differences? And then also compare that to, what was it like buying a home a year ago then, too, when you had low rates? And what was the environment like when you had to purchase that home?
Yeah, it's pretty telling, Rob, when you put numbers to things. It adds, I think, some clarity because a lot of the buying processes are it's our psyche.
Yeah.
I always tell first-time home buyers, like, you will never spend more money than you're spending now on a house. It's a huge purchase.
Yeah.
I mean, we talk about these numbers. We talk about, $500, $600, $700. That's a lot of money that we're spending. But when you look at the interest rate and you say, okay, is it better to buy now? It's 6.25, which rates vary, but that's pretty close to the national average on a 30-year fixed rate mortgage.
Yep, I would agree. It's been bouncing in there, so let's use that.
Okay. So if you say, okay, right now the median home price in Bend, most of, I'm not going to say Central Oregon because those pockets change, and you're much more acquainted with that than I am.
Sure, we'll talk about Bend.
But it's hovering around 700,000. I think March the number was 660. Maybe it's up a touch from here, but just if you took an average home price of 700,000 and you put 20% down, so you didn't have to worry about mortgage insurance or anything like that, just a standard deal, just to kind of illustrate the difference, it's 6.25. The principal and interest payment with taxes, insurance, that's going to vary a little bit, but roughly your home payment's going to be about $3,800 a month.
Okay, for 6.25.
It's 6.25
on a $700,000 purchase.
Yep,
Got it.
20% down.
Okay,
with a loan amount of $560,000.
Got it.
So $140,000 you put down, $3,800 a month. That same house, if it was $700,000 at 3.25, would be $2,800 a month. So,
$2,800 a month, so about $1,000 difference.
Yes.
Okay.
So that's where, if we pay attention to the headlines and we listen to Diana Olick and others that are just saying, my goodness, that has created some, who can afford an extra $1,000 a month?
Right.
It's a good point.
Yeah.
I wouldn't want to take that out of my budget right now either. So that's important.
But if you think about it big picture, $12,000 a year. It's not like 50,000. It's so 12,000, is that a lot of money? Absolutely. That's a couple incredible vacations.
Correct. And I think as consumers, we tend to, when it's the negative, we take it to the extreme. It's, oh my goodness, I've got to pay $1,000 a month more for the next 30 years of my life.
Right. They take it for the rest of their life, kind of a thing. Yeah.
Correct. And that's understandable. But if we take a pause and we say, okay, hold up. Okay. So let's just take that same 3.25 rate and buying that house last year. Well, guess what? That home wasn't 700,000 then.
Nope.
That home was probably what? 800.
Yeah, it was close to 8. Probably 100,000 or $90,000 more. Plus, you were competing with 12 other buyers who wanted to buy that house. And that's how the pricing got to that high, because everyone was making, offers $100,000 over asking price.
Yeah. I challenge anybody to go talk to a family member or friend and go ask them how fun the home buying process was for them when they had 3.25%.
Yeah. Awesome interest rate, horrible purchasing environment because it's so competitive. You have to throw out basic things like home inspection. You have to, give away the farm in order to get the house. And you might be paying $100,000 more versus today. I think I see your point. Versus today, yes, interest rates are higher, but you're paying $12,000 more a year for right now until you potentially refinance.
Correct.
Got
Yeah.
it.
And so to me, I think that's something for your audience. And I think that if you're vacillating and going, okay, should we pull the trigger? Typically, the market will pull the trigger and all feel good at about the same time. When the headlines all say rates are coming down, they're low. And guess what? When the market gets flooded with buyers, then it becomes very challenging. Then we're back into that same environment. So seizing an opportunity is you kind of have to seize it or be farsighted and say, okay, what's the market going to do? It is coming down interest rates. We don't have a crystal ball. We can't say it's exactly going to be this, but just going back to those numbers, if you say, okay, I'm going to pay another $1,000 a month, is it better to pay $12,000 more for that house in interest over a year?
Which is tax deductible, by the way.
Correct. You get a 1098 form at the end of the year. You can give that to your accountant and benefit from it. And also in that year time, the appreciation of that home probably goes up even in a conservative market. What, Rob? Maybe 10%?
Sure. Well, 5 to 10 in a conservative 5 to 10 in a conservative market, I would say.
Yeah.
5 to 7.
So still better than renting.
Yeah.
Because you've got appreciation value. You get, the offset. You're paying more, but you get the tax benefit. But when I look at it and I say, okay, I'm $1,000 a month, $12,000 versus bid over asking. The median home price last year, I was just looking it up in March of 2022 was $773.
Yep. In March of last year. 22.
Yep. So when that rate was 3.25, this same house was not $700,000. Today it would be $808,000 or almost $809,000. So we can't forget that little piece of intel.
Yeah.
Because
your house price is going to be so much more.
Correct.
Yeah, that's the one thing that's happened with these interest rates is it's created a little bit of a pocket where people can get back into the market because pricing's got a little bit more affordable.
Correct. I mean, I've done several loans for first-time homebuyers this year, putting as little as 3% down. That did not exist a year ago. It was very difficult because a seller, they're looking at 20 offers. You list a lot of houses.
Yep.
Which offer are you going to take?
Yeah.
The one that's putting 50% down
or 3%. You definitely want to take the ones that's
correct. Because a 3% down loan, while still securing a good loan, it does have inherently issues that could happen with a first-time home buyer. So they didn't even have opportunities. It was sad for many first-time home buyers. So right now, yes, it's not ideal, and yes, it's going to cost more, and you still have to qualify. But the other thing I want to say is when we talk about, over a 12-month period of time, that's important to remember because likely 12 months from now, just about everybody in the industry, including myself, feel very strongly, and we're going to get to predictions, but rates aren't going to be where they are now. Likely, if inflation falls like it should, rates will normalize. So guess what? When you buy a house, that home price becomes fixed when you buy it, but the interest rate isn't.
All right. Well, before we go any further, I'm going to mention our sponsor of the show today, which is Duke Warner Realty. Duke Warner Realty is a premier real estate firm here in Bend that was established in 1967 by Duke and Kitty Warner and is still family owned and operated to this very day. Duke Warner Realty has served thousands and thousands of customers throughout Central Oregon over the last 55 years, and the brokerage not only features Bend's best real estate agents, but also the most experienced, with the average agent at Duke Warner having 15 years of real estate experience. If you want your next real estate transaction done right, with honesty and integrity, give Duke Warner Realty a call at 541-382-8262 or visit them online at dukewarner.com. All right, Brandon. Well, really good stuff so far. And one thing that's sticking out to me is this $12,000 difference, because you described that going from a 3 to a 6.25, that person's paying about $1,000 more per month, $12,000 a year. That's a deal breaker for a lot of people. And I'm not trying to minimize that, because I said, yeah, it's not 50. It's not 50, but the reason I said that is because you're not paying $50,000 or $100,000 more in your purchase price. So you're not bidding up the home. Your purchase price is a lot lower, but still $12,000 is a lot of money. And it could be a deal breaker for some people. So what are the ways that people could potentially mitigate that or bring those numbers down a bit, make it a bit more affordable?
Yeah. Boy, great point. At the end of the day, we can say, well, $12,000 better to pay than 50 or 75 or 100 in home price. But at the end of the day, you still got to afford another $1,000. So that is good. But one of the ways that we mitigate that, or at least we try to present to buyers, is to say, well, we know that if mortgage rates follow inflation, which they do, likely, then in the next year to 2 years is a pretty safe bet that interest rates should be substantially lower or much lower than they are currently.
Okay.
I haven't really run into anybody that disagrees with that. Once in a while, somebody will say, well, I remember back in the 80s and, interest rates stayed that way for a long time. And it is true, but I always say, go back and look at inflation. It wasn't controlled. It too stayed high.
Yeah.
And that's why the Fed took such drastic action to get inflation under control. But if we look at that $1,000 a month, how do we reduce that? And one of the ways is called a temporary buy down. And the reason it's temporary is Fannie Mae, Freddie Mac, even FHA, VA, they all allow you to buy down the interest rate by 2 points, 1 point, even 3 points. Meaning,
wow,
if your rate is 6.25, you could actually get to 3.25.
Would that be considered 1 point?
That in that case would be 3 points.
That's 3. So
Yeah.
the whole, okay.
So
the 3.25. Yes, of course.
Correct. So you
6
could
to
do
3.
what's called a 3-1 buy down. 3-1 buy down says, okay, if the market rate is 6.25, we'll give you 3.25 for the first year.
Oh, wow.
4.25 for the second year. 5.25 for the third year.
Okay. I have a client who's doing a 2-1 buy down right now.
I've done a lot of 2-1 buy downs. Same thing. If it's a 2-1 buy down, if rates are 6.25 right now, that means when you get your mortgage, your first year is going to be at 4.25, 2 points lower.
Yep.
For the first year. The second year, it goes up 1 point to 5.25. So now you sit here and you say, okay, wait a minute. So how do I afford this extra $1,000 a month? Well, with the buy down, now all of a sudden for that first year, that payment's not going to come down quite $1,000. It would with a 3-1 buy down. With a 2-1 buy down, it's probably going to be $600 or $700 less than that. So that's a huge way. But then you say, well, wouldn't I have to pay for that buy down? Well, that's what's cool is the seller has to pay it, not the buyer. Loan programs don't allow the buyer to pay for it. So then the question I would say, Rob, is, well, would sellers even pay that? But they would in this market.
That's interesting because, yes, they would. Not everybody.
Right.
It's a brand new listing and it's an awesome house and everybody wants it. You might have a hard time getting that done.
Yeah.
But there's a lot of sellers that would be open to that now. A year ago, absolutely not.
There it is.
Yeah, absolutely not.
So to me, that's the point,
Yeah.
is that why is now a good time to buy? One is, yes, the interest rates being high have allowed buyers to have more flexibility in their loan options. They have sellers that are willing now to negotiate and pay a buy down to help mitigate or offset some of that extra cost that you would pay in the higher rate.
Yeah. So the 2-1 buy down buys the loan down for 2 years. The 3-1 buy down buys or reduces the loan adjustment period for 3 years. Is that correct?
Yeah.
Okay.
So kind of the way I look at it is I say, okay, if you do a 2, you can even do a 1-1 buy down too.
Just for 1 year then.
Or 2 or a 3 year. But in any of those cases, I say, well, so that means now, no matter what the interest rates do, for the next 1, 2, or 3 years. You know exactly what your payment's going to be. Mm-hmm. The seller has subsidized your interest rate, and they've paid this for you.
Yeah.
The cool thing, too, with a buy down is if you decide to refinance before that, let's say in 1 year time, interest rates fall back to 4% or 3%.
Yeah.
Who knows? And you say, well, man, I'm stuck at 5.25% or 4.25%. You can refinance anytime.
Anytime. There's no prepayment penalty.
You can refinance in 6 months if the rates drop.
Nice.
But what happens to that buy down subsidy the seller gave you? Because sometimes that could be $10,000, $15,000 to buy it down.
Yep.
Well, you get it. The seller doesn't get it. It's
if
your
you
money.
Refinance, you get the
Yep.
Wow.
Yep.
That's amazing.
It is. So again, to me, when you really look at the numbers and you really look at the opportunities to buy, it's much better now than it was a year ago.
Yeah, a year ago, you're certainly not getting a seller to buy down the rate.
No.
In fact, if you even mention that in your offer, they'd be on to the next one.
Yeah. In fact, I can't even remember, when we were writing pre-approval letters as lenders, it was like a resume. I mean, basically, it was like a job interview, and you had to write as glowing a resume. They were, your buyer, even if they didn't want to put 40% down, sometimes we had to say, look, you're going to have to tap into a 401k or something to put more down to have any opportunity to be accepted by the seller. Mm. And so, so now we fast forward to this year. And like you said, it's not every seller is going to do it, but there's certainly a lot more sellers now that would be willing to negotiate than there were last year.
So what kind of numbers are we actually talking about the seller contributing? Like, are they having to contribute 20 grand, 5 grand? What does it look like?
Yeah. So I would say, there's a little formula to figure out the subsidy. But again, the subsidy is based on the difference between the market rent and the buy down rate. So we take 12 months. If we go from 6.25 to say 4.25, then we got to figure out what that delta is between what the interest that's really due. Because when you actually sign your loan documents, you'll notice that the note and trust deed that's recorded, the note rate is 6.25. That is your interest rate. Mm. But then a buyer will say, wait a minute, I thought I had 4.25.
Yeah.
And you'll see a separate disclosure that'll say, yes, it's a buy down agreement. So it's kind of like an escrow account, but in that amount, I'm going to say it's going to vary probably in this $700,000 range. That buy down subsidy is probably going to be around $11,000 to $13,000.
Okay. So real world example, we'll just say $700,000 house.
Yep.
And let's say it's been on the market for 2 weeks.
Yep.
Hasn't sold yet. Or maybe it's been on the market for 30 days. You go to that seller and you say, hey, we're gonna, how would you do it? Would you offer full price and then say, let's say you wanted 10 grand off, offer him 700,000, but then you would say seller to contribute 10 towards my loan buy down?
Yeah, exactly. Mm-hmm. In fact, we've done that numerous times. And in some cases, I had one, this has been a couple months back, but it was a VA, so it was nice for our veterans because they were able to not only get the entire buy down paid for, which was $12,000, and it was on new construction, but we got the seller to pay that and all the closing costs. So the total was around $22,000.
Okay.
So they offered a full price offer.
Yep.
But the seller was contributing $22,000 toward buyer's closing costs and buy down subsidy.
Wow.
So two different things. Now that's not super common, but that did happen.
It's a full price offer, but it's not a full price offer net to the seller.
Correct.
Yeah.
Yeah. They're having to concede.
They're coming down a little bit. And again, in this market, you can do that.
Correct.
Case by case scenario.
Yeah.
A year ago, you couldn't.
No.
Impossible to do that. So there are some ways to knock that down. And then if you do say get that rate down to like a 3 or a 4, then you just are hoping that, like you said, interest rates drop back down and you could refinance and it doesn't even go adjust back up.
Yeah. So really, just to kind of recap, if I'm a buyer and I'm sitting there saying, okay, I know I need to buy, I want to buy. My son is getting to that point and I'm helping him through that process. And I said, just remember, the second you buy that house, if it's in Central Oregon, and this is around $500,000 purchase price.
Mm-hmm.
I said, likely in a year's time, you're going to have probably close to $50,000, $30,000 to $50,000 worth of equity already built just for living in it.
Right.
I mean, that's pretty compelling. And he said, oh man, I got to buy it. I said, yeah. But so then now with the interest rates, so to recap, now we have an opportunity for first-time home buyers and other buyers with limited funds to get an offer accepted.
Yep, exactly.
And the lenders can all now provide a buy-down option. So now you don't got to pay another $1,000 a month because of these interest rate increase. We can mitigate some of that. So maybe now the increase is only maybe $200 or $300 a month more than it was a year ago.
$200 or $300 a month more versus spending $75,000 in a bidding war last year.
Correct.
I mean, that's a huge difference.
Yeah. So
when you explain it like that, it does make sense that this is a pretty nice buying environment, actually.
It is, and I think the one thing though that we do have to, it's not nirvana by any means.
Sure.
But I think when we look at the doom and gloom of, well, this is horrible, the only thing I would say that can be a challenge is that when you do qualify for the loan, you still have to qualify at the higher note rate of 6.25%.
Okay.
So in other words,
with the buy down package?
Correct.
Got it.
So even though that's what your payment's going to be, the lender doesn't say, okay, so if your payment now
that's smart, actually.
It is.
Because then if it adjusts to the high number, they can still afford it.
Correct.
And that's where we got into so much trouble in 2008.
Correct.
Is when everyone's loans adjusted after a 5 or a 3 year ARM, they couldn't make that payment.
And they had no way of actually affording it. It wasn't even. So now, obviously, through the Financial Reform Act that happened in 2010, Dodd-Frank, that predatory type lending is gone. So when we say, okay, we're qualified, we're going to give you a rate of 3.25%, but we're still going to make sure that you're qualified at 6.25%.
At the highest it's ever going to be.
Correct.
That's super smart because that just turned into a foreclosure nightmare for people back then. So
Correct.
It sounds like that mitigates that issue right there.
It does. And what that means for the buyer sometimes is they say, well, just for easy math, if your qualifying loan payment is $3,000 a month and you have no other debt but just the mortgage, you got to make a minimum of $6,000 a month. It's 50% debt to income ratio to qualify for that loan payment. That's the bare minimum if you have great credit. So now all of a sudden you start thinking about it, and that's where sometimes, depending on the loan amount, it can be tricky to qualify for it. But if you can, and again, you're good. If you got a good lender, he's going to walk you through all that. But boy, my suggestion is if you're even remotely thinking about buying, I would dive in to the numbers, get the real detail and intel, because I think you'll find that now is a really, really good time to buy.
That makes a lot of sense. All right, so to wrap up our last segment of the show, let's talk about predictions. So where are interest rates going to go for the rest of 2023 to the best that you can see into your crystal ball?
Yeah, I mean, I think, yeah, jeez. I think I was telling you before this, like, who's Brandon Roberts? I mean, what do I know? I'm just a mortgage advisor, but I've been doing this, a while. And the one thing I know is that mankind always finds some other way to throw a monkey wrench in things. So we think things are going along fine.
Of course.
Even last year, who predicted a pandemic,
right,
or a war in Russia and Ukraine, and the complexities that throws into things. So barring no craziness,
meteor hitting the United States.
Yeah, if we can count on those things. Again, when we look at mortgage rates, they follow inflation. So for me as a mortgage professional, I'm watching very closely the things that go into mortgage or into the inflationary numbers. And everything would indicate that if we're cresting now and every month they release information, we can pretty much figure out based on inflationary numbers how that's going to affect the bond market and the 10-year treasury. And we can predict pretty closely the spread between the two, which is the mortgage rate you're going to pay. So I've listened to a lot of smart people that feel pretty strongly that we're going to see interest rates back in the low 5s this summer.
Wow. Low fives.
Low fives. Yeah.
So a point lower than what, say we're at 6.25 today, so 5.25-ish.
Correct.
Okay.
Correct. So, and again, the optimistic side of me that hopes for that thinks that that's pretty realistic because again, look how aggressively interest rates rose.
Yes. I mean, they've fluctuated so much. We saw like a half a point in a matter of a week or so.
Correct.
Yeah.
And fundamentally, usually the faster things go up, the faster they also come down. There's a reaction that's equivalent. Whether that takes a year or two to get back, people have asked me all the time, are we going to see 3% again? I absolutely believe we will at some point.
Really?
Because we go into recessions. The only way you get out of recession is make credit more available.
Yeah, stimulate the economy.
And I can't see that from here on out we're going to be flat. It's just not the way of a global market.
Right, that makes sense.
Ups and downs. So to me, absolutely we'll see that again. I don't know at what point, but I think if I was to predict, I think it's pretty reasonable to think that we'll be back in the low fives this year. Could be even lower. Could be higher, but that would be my estimation at some point by this summer and fall that we should see those interest rates back again. But regardless, we still have the temporary buy downs, which will only benefit if interest rates are 5.25. Guess what? You could get a 2.25 rate for 1 year on a buy down.
Yeah.
So to me, interest rates are not the most important thing. There's always ways to mitigate and benefit from that ever-changing dynamic. But the home price, that's the one that gets stickier. And if you can seize an opportunity to get home prices where, because of inventory, and that's a whole nother podcast, I'm sure. But I think rates are going to come down pretty quick.
Awesome. Well, I'm going to hold you to that.
Okay. All right. If you never see me on here again, you'll know I was way off.
If they're still at 6 or 7 in November, you owe me lunch. How about that?
I'm out of business. Exactly. Don't listen to Brandon.
No, that's great. I hope that's the case, and that'd be good news for the housing environment and just for buyers, make things more affordable again. But at least in the meantime, there are some solutions to mitigate the high rates, to do like a buy down or whatnot. And really the key to that is talking to a professional like yourself. So how do people reach you? You can give yourself a quick plug for your phone number, throw it out there so people can reach you.
Thanks, Rob. I appreciate that. Yeah. My phone is probably the best, 541-891-5547. Text me, email me. Email is brandon.roberts@nationslending.com.
Well, that is awesome information, Brandon. Sure appreciate you coming on today. Very helpful. And look forward to working with you the rest of the year here too. So
thanks, Rob.
Anyway, guys, thank you so much for joining us today. If you're on YouTube, please leave a comment. We'd love to know what your thoughts are. Give us a like on there as well and subscribe to the channel. And if you're listening on a podcast app, please follow the show and give us a 5-star rating and share it with a friend. Let them know about the podcast as well. And thank you so much for joining us, and we will see you next time. Take care.